Okay, hi guys. So, what we're going to be talking about now is the economic calendar. Okay, so the economic calendar here, which is on uk.investing.com, I'll provide the links in the description below. Now, what this does, it provides us with all of today's information that is being released. Okay, now this information helps us determine whether the value of a currency will go up or down. Now, um, personally, I believe it's about 80% is fundamental analysis. So this is actually going on the charts. You're doing all your analysis. You're drawing, say, your support and resistance. So I'm just doing some quick stuff like that, and so you could be doing your fundamental analysis like this, or you could be doing trading off technical analysis. Now, I find when you use these two, they work in synergy together because it helps you determine stuff that's happening, and you can actually use live data to also help you determine which way the market's going to move. Okay, so now I'll give you a few examples of how this works. So say for instance we are on tradingview.com. We can see there's USD MBA mortgage applications. Okay, now for instance, let's talk about mortgage applications. Say the previous percentage was 2.3% applied for mortgage applications. Now, imagine if we had a forecast of upwards of 2.3%. So say we had a forecast of 5%. A bit unlikely, but say we did. Now, that huge increase would indicate to people that a lot of people are in good jobs. Maybe the middle and the lower class have moved up. So they're generating more income. They've got more disposable income. They've got money saved in the bank. And now they're looking to buy a house. Okay. Now, as a whole, just from the mortgage applications, we can determine that the dollar might be very strong because a lot of people are applying for it. People are in good jobs, and obviously this means the economy is doing good. Okay. So in a bad economy, you wouldn't see people applying for mortgages. People would be renting places, they'd be living outside of towns. But the fact that people would be applying for mortgages gives us some sort of idea that the dollar will be strong. So this could be for anyone. This could be if it said GBP, that would be the pound mortgage applications. But we're looking at the dollar ones. Okay. So now, how can we use this information? So as we got the pound against the dollar. So what this means is we're comparing, the pound against the dollar, okay? And when there is, say there's good information about the dollar, so say the mortgage applications have gone up, okay? So what we're looking to do and what we understand is that the dollar is going to be stronger than the pound. So the pound's going to be here, the dollar's going to be here. And what this means is that the dollar's dominating, and it's going to drive the price of the pound down like this, okay? Just like that. If, however, the mortgage applications was lower than the previous, so maybe 1% of people applied for a mortgage application, then we'd start to be a bit, weary. We'd say, well, last time it was 2.3%, and this was, say, for instance, it was this time over here, okay? Now it's a lot lower. Less people are applying for it. So maybe the dollar's starting to get weak. The economy's not doing very well. And it starts to, a lot of questions start to arise. So then we could be seeing the pound start to move up against the dollar. Okay. So all this is, when you look at pound against the dollar or any currency pair, all it's doing is comparing the value of one pair against the other. Okay, so just it's not hard to understand. It might be at first, but once you get the hang of it, it's not hard. So if the pound's doing well against the dollar, you're going to see this. If the dollar's doing well, the pound's going to drop. You just have to look at it from a different perspective. And the easiest way, when I first started, would be to flip it round. So as you can see, it's GBP USD. Say for instance, we're going to look at it from the other perspective. So USD GBP. Now you can see that the dollar's rising against the pound, so the dollar's quite strong. But we don't really want to search this way round. We have to keep it the other way round because that's how everyone else is trading. It's just going to confuse you if the charts are upside down. There's no point putting stress on yourself when you don't need to. But yeah, that's just covering, a bit of the currency pairs. But going back to the economic calendar. Now, as I mentioned, this data gets released, okay? So this is released every day. There's always something coming out wherever in the country or the world, sorry, you can see we've got Spain, we got, is that Sweden, Norway, I think? Is that Singapore? Yeah, Australia. So we've got loads of different stuff here being released. But what we want to keep an eye out for are these bull horns here. Okay, so the more the horns, the more pictures of a bull there are, that means the more important the news is, and the more likely it's going to affect the markets. Okay, so if we're trading the Australian dollar and there's one bull bar, news there, we're not even going to look at it because it's not going to affect us in any sort of way. It's going to move the market just slightly. You won't even be able to notice it. Okay, what we really want to do. Okay, so how we do this, we filter the market. So we select, say you're just focusing on the pound against the dollar, you'll clear everything, and you'll just have, United States, United Kingdom, just like that. And sorry, I forgot to apply it as well. Apply. And then we've only got US data and UK data on our screen. Okay, so that's a really easy way to do it. Now, what we want to do is select the important news only. So we leave this one here and this one here. Now this will tell us, okay, as you can see, there's important news coming out soon. The reason I want you to understand the economic calendar is because it's going to benefit you in a way. So for instance, this data gets released. So say in 47 minutes, that's at 12:30. This data is going to get released. Okay. Now, when the data gets released, you won't be able to trade off the data because by the time this website's been updated here, it might be 30 seconds after because someone has to type it in, put the data in, upload it, refresh the website, whatever. It's going to take a bit of time. But by the time the data has even been released, before it's even been released, the big banks, some hedge funds already know the data. Could be insider information, we don't know, but they already get the data. They're already moving the market in the direction they want it to move. Okay, so the best thing we can do, and to use the economic calendar to our advantage, would be to look at the times and say, right, okay, let's avoid trading at 1:30. Okay. We'll avoid this time here. We'll avoid 3 o'clock and 3:30. Okay, it's just for us to protect us because obviously the last thing you want to do is doing some fundamental analysis. It's broke out here, retraced back up to the resistance line, and now it's going to fall. Last thing you want to do is place a put, saying it's going to come down. Some news comes out and it shoots up in the other way and you've lost your money, okay? That's the last thing you want to do. So if you're just sticking to fundamental analysis, which I advise, just use the economic calendar to avoid the times to trade, okay? Don't trade off the data because it'll be too late by the time you'll be trading it. So say you hop on the bandwagon, you try to trade it. By the time, this is how quick the data comes out, within a second or 2 seconds, it's already moving in the way it wants to. By about 30 seconds, it's peaked. And by the time you've entered your trade, which takes 5 seconds, it'll already be reversing on you for you to even benefit off the trade. So you'd lose the trade anyway, okay? So it's not worth you doing, okay? And sticking to the economic calendar as well, you really want to avoid the non-farm payroll, okay? So this comes out, hasn't even come up here. There we go. So it's reported at the end of the month. There you go. Is a monthly report reported by the US Bureau of Labor Statistics, intended to represent the local number of paid US workers of any business, despite the name Non-farm payroll report excludes workers from general government jobs, private household jobs, employees of non-profit organisations, and farm employees. Okay, so here we go. Payroll statistic is reported monthly on the first Friday of the month. Okay, so my advice would be just not even trade on that